Recording in progress.
Good day, everyone, and welcome you all to ICRA's webinar. Ms. Aditi Nair will take you through the presentation. The presentation will be followed by a Q&A session with the participants. You can place your questions in the Q&A box. Over to you, Ms. Aditi.
Good afternoon, everyone. Thank you for joining us today. I'm ICRA's Chief Economist Aditi Nair. On behalf of ICRA, I welcome you all to today's webinar on India's outlook in the post-pandemic world amidst the geopolitical uncertainty, sectoral outlook, and the ratings performance. With me today are Jitin Makkar, Vice President and Head Credit Policy, and Prateek Singhania, who's also Vice President in the Credit Policy team. We're going to start off with Prateek talking about the ratings performance for FY22 and the sectors experiencing the most ratings activity in terms of upgrades and downgrades. Then I will briefly take you through the macroeconomic outlook for FY23 amidst all the geopolitical uncertainty that we're currently faced with. Finally, Jitin will discuss ICRA's sector outlooks. He will elaborate on the fundamental trends across sectors influencing our outlook revisions and the implications from the geopolitical disruptions on the sectoral outlook. This will be followed by a Q&A session. In the Q&A, we will be joined by Mr. K. Ravichandran, ICRA's Chief Ratings Officer, and Mr. Karthik Srinivasan, ICRA's Group Head for the Financial Sector Ratings. With that, I hand over to Prateek. Over to you.
Thanks, Aditi. Good evening, everyone. We would start the presentation by giving an overview of the rating distribution of ICRA's portfolio of rated entities. The composition of ICRA's rated portfolio has undergone a change over the last few years. The median rating, which was in the BB rating category until the beginning of FY19, has shifted to A category at the beginning of FY22. With the change in the composition of the rated universe, the share of the investment grade entities has also increased to 72% at the beginning of FY22. It must, however, be noted that the shift in the rating distribution is not because of any general improvement in the credit quality of the entities, but due to discontinuation of ICRA's rating coverage on the large number of entities owing to lack of cooperation from such entities. Next, we would cover about rating drift, rating volatility, which along with the credit ratio are the key metrics which are tracked to monitor the rating actions in the rated portfolio. While the credit ratio indicates the direction of the rating actions, that is the number of entities which were upgraded in relation to the number of entities which were downgraded. Rating drift and rating volatility also considers the magnitude of rating changes, that is, the number of notches by which the entities were either upgraded or downgraded. The difference between rating drift and rating volatility is that rating drift considers net movement of the rating changes. That is, it is a difference between the cumulative number of notches by which the entities were upgraded and cumulative number of notches by which the entities were downgraded. A positive number indicates that among the entities which underwent a rating change, the cumulative number of notches of rating upgrades was higher as compared to the cumulative number of notches of rating downgrades and vice versa. The rating volatility, on the other hand, is always a positive number and considers the gross movement of rating changes. That is, it is agnostic to the direction of the rating change. In FY22, the rating drift of ICRA assigned ratings turned positive to 9%, which was highest over the past many years, with the past 5-year average being minus 9%. A strong upgrade momentum, along with relatively lesser number of defaults, contributed to the rise in rating drift in FY22. Even in FY21, the rating drift had turned less negative at minus 6 compared to FY20 because of substantially reduced number of defaults, as well as lesser proportion of downgrades because of fiscal and monetary policy interventions that had supported the credit profile of the entities. The rating volatility stood at 37% in FY22, though it is higher than that in FY21, but it is broadly in line with the past 5-year average. Next, we would cover the credit ratio. In terms of the credit ratio, since November 2020, the credit ratio has generally remained upwards of 1 times each month. Prior to that, the credit ratio has consistently remained below 0.7 times since May 2019. In FY22, ICRA upgraded the ratings of 561 entities and downgraded the rating of 184 entities. This results in a credit ratio of 3x times, a significantly higher number compared to that seen over the last two fiscals. It was 0.6 times in FY20 and 0.9 times in FY21. Next, we will cover the trend in terms of the debt upgraded and downgraded. Similar to the trend observed in the credit ratio expressed in number of entities, even in terms of debt, the volume of debt upgraded was much higher as compared to the debt which was downgraded, reversing the trend observed in the previous years. The non-financial sector contributed to the bulk of the debt which was upgraded, and around half of the total debt upgraded were in the sectors such as ferrous metals, power, real estate, fertilizers, and construction. After covering the overall trend and the magnitude of the rating actions in the rated portfolio, we will delve into a bit more detail into the upgrade and downgrade rating actions. Generally, the ratings for around 80% of the entities in the portfolio remain the same, and it is the balanced 20% of the portfolio which typically experience a rating change. The share of upgrades and downgrades within this 20% pie changes each year based on various macroeconomic, sectoral, and company-specific factors. But in FY22, the share of the pie which experienced a rating change increased to 25%, driven by an increase in the share of rating upgrades. In FY22, 19% of the entities were upgraded as compared to the past 5-year average of 11%. Moreover, the proportion of entities which migrated to investment grade from non-investment grade, which we also refer to as the rising stars, increased in FY22 to 3.6% from 2.1% in the previous year. In terms of downgrades, in FY22,
Shall we could move to the next slide, please?
In terms of downgrades in FY22, the ratings of 6% of the entities were downgraded as compared to 9% in the previous year and 13% in FY20. Similar to the trend of subdued downgrade pressure in FY22, the proportion of fallen angels, which are the entities which are downgraded to non-investment grade from investment grade during the year, also declined to 1.4% in 2022 from 2.3% the previous year. Next, we would see the ordinality in rating actions. This chart reflects the rating actions, the ordinality in rating action which has been observed. As we see, the lower the entities, the higher the share of rating downgrades which has been observed, indicating ordinality in the rating actions. Next, we would cover a bit about the default rates. In terms of the default rate, it continues to remain at multi-year low at 1.3% and was similar to that observed in FY21. Lesser number of defaults in FY21 were largely an outcome of relaxation provided by the regulators to the rating agencies in terms of default recognition, besides the timely alternate funding available by entities from lending institutions to manage their liquidity. The continued benefits of the alternate funding availed, as well as a rebound in business activity during FY22, elevated the default pressure in FY22. Next, we would cover the key sectors which upgraded a high share of upgrades and downgrades. Now, the key sectors where the overall share of upgrades and downgrades in the overall pie are highlighted in this chart on the screen. While it was the entity-specific factors which drove a significant number of upgrades in sectors such as power, real estate, construction, engineering, and roads, industry-level factors like steady demand, higher price realizations, and expansion in profit margins drove the upgrades in sectors such as ferrous metals and textiles. The hospitality sector, which was one of the sectors that had been mostly badly hit by the pandemic, continued to experience a high downgrade rate in FY22 because of the persistent weakness in occupancies and average room rates. However, in March 2022, ICRA has revised the outlook on the sector to stable from negative. To summarize, the credit quality of Indian corporate sector has experienced a rebound in FY22 on the heels of 2 consecutive years of pressures caused first by the slowdown in economic activity in FY20 and then by the pandemic in FY21. As businesses and policymakers adapted to the challenges and as the economic repair work progressed, the incremental downside credit risk ebbed in FY22. As a result, the instances of downgrades were multi-year low, while upgrades were at multi-year high. I will now hand over the presentation back to Aditi, who will cover the macro outlook.
Thanks, Prateek. Moving on to the next slide. Just as the economy was recovering from the impact of the third wave in the first half of Q4 of FY22, the Russia-Ukraine conflict has renewed a lot of uncertainty and injected a lot of volatility as far as the macroeconomic forecasts are concerned. So I'm going to briefly talk about the impact that we're seeing from particularly the geopolitical conflict as well as the commodity price hike for Indian macros in terms of the GDP growth, inflation, the fiscal deficit, as well as the current account deficit. So firstly, the spike in commodity prices that we've seen over the last couple of months is really expected to aggravate inflation and also compress disposable incomes of households and the margins of producers. Added to this, the supply chain disruptions which we're seeing emanating both from the Russia-Ukraine conflict as well as from the lockdowns in parts of China are a constraint that we now need to build into our forecasts. And we now project India's GDP growth in real terms to moderate to 7.2% in FY23 from 8.5% in FY22. So just to elaborate on the impact on the disposable incomes, higher prices of fuels and items such as edible oils are likely to compress disposable incomes in the mid to lower income segment, which will constrain the demand revival in FY23. In the mid to upper income segment, what we expect is a normalization of behavior after the third wave, which is actually likely to shift consumption more towards the contact-intensive services that were avoided during the pandemic. And this is something that is likely to constrain the growth in demand for goods in FY23. Therefore, we are expecting the rise in capacity utilization to be quite gradual over the next 3 quarters, even though exports of some items will rise to meet the global demand in the middle of the supply crunch that we're seeing right now. An early kickoff to the Government of India's budgeted capital expenditure program will really be crucial to boost investment activity in the first half of this fiscal year. However, we just want to note that the execution risk is shifting to the states, with a large portion of the step up in Government of India's budgeted capital spending coming through the increase in the size of the interest-free Capex loan to the state governments to 1 trillion rupees in FY23 from 0.15 trillion in FY22. Therefore, the associated pickup in the project awards and the further enhancement in the pipeline for the construction entities remains to be seen. A quick word on the agri sector. The reservoir levels are quite healthy right now, and they do offer insurance against a potentially below normal monsoon in 2022. As economic activity normalizes, we expect there might be a shift in the availability of agricultural labor across different regions, which is perhaps something that is going to affect acreage in different states. A rise in acreage has been a very important driver of agricultural output in FY21 and FY22. Other than that, we're also concerned about the potential inadequate availability and high prices of fertilizers. Therefore, growth of crop output may be quite modest at best in FY23. Despite the prospect of enhanced exports, agri incomes and sentiment may witness a tempered improvement in the months ahead. And this has implications for the sectors that cater to the farm portion of the rural economy. Now, on the inflation side, as you can see on this chart, we expect the Cpi inflation to average at 5.4% in FY22. There are 3 major channels of a rapid transmission of the spike in commodity prices into the Indian Cpi inflation. Firstly, edible oils, secondly, fuels, and the third is gold. Other than that, in an uncertain demand scenario, while input price pressures will transmit into output prices, the impact will be relatively gradual. Overall, we expect the Cpi inflation to average at 5.6% in FY23, slightly higher than the 5.4% that we project for FY22. Specifically for the current quarter, if we assume at the average price of the Indian crude oil basket at $150, $15 per barrel, and a full transmission to the retail prices of petrol and diesel within this quarter, then we are projecting the Cpi inflation at 6.3% in Q1 of FY23. A cut in the excise duties on these 2 items to pre-pandemic levels could contain the Cpi inflation average for Q1 to 6.1%. But in either scenario, we're looking at the Cpi inflation being higher than the MPC's upper target, the upper threshold of the MPC's medium-term target band of 2 to 6%. Later this week, we have the policy review for April 2022. We are expecting the Monetary Policy Committee to revise up its CPI inflation forecast and reduce its growth projection for FY23. At the same time, we are expecting a status quo to be maintained on rates given the uncertainty because of the impact of the Russia-Ukraine conflict. However, with the CPI inflation having printed in excess of the MPC's upper threshold of 6% in January and in February 2022, and the expectation of it remaining above 6% in March and on average in Q1, we do expect the tone to be a lot less dovish than the last policy review, preparing the ground for an imminent stance change. So thereafter, we expect the monetary policy stance to be revised back to neutral in June 2022. We expect this to be accompanied by a hike in the reverse repo rate. After that, we are projecting a shallow rate hike cycle with 2 repo rate hikes of 25 basis points each in the August and the September 2022 policy reviews. Nevertheless, with the large borrowing program of the Government of India, we do think GSEC yields are going to rise ahead of the increase in the repo rate, mirroring the global trends. Once the borrowing program kicks off for FY23, which is this Friday, we expect the 10-year GSEC yield to quickly move above 7% and range between 7 to 7.4% over the next 6 months. Moving on to the next slide on the Government of India's fiscal deficit. So the Government of India had budgeted for a fiscal deficit of rupees 16.6 trillion or 6.4% of GDP for FY23. This is likely to be adversely affected by the current geopolitical situation on account of 4 reasons. One, we are looking at potential excise duty cuts. If we have a full rollback to the pre-pandemic level of the excise duties on petrol and diesel, then the impact of that would be about 92,000 crore. Also, there would be high fertilizer and food subsidies warranted by the current situation. We've already seen the free food grain being extended for 6 months up to September 2022. Although this is something which is actually likely to help ease the pressure on the households' budgets as far as the food budgets are concerned. Lastly, we expect that the compressed growth in direct taxes will be a consequence of the lower profit margins of corporates. So in terms of the upsides, in terms of the revenues, there are 3 factors that we need to consider. One is that the budget for FY22 had built in a very modest nominal GDP growth, which we expect will be substantially overshot in FY23. And also the tax fluency assumptions made in the budget were quite, I would say, on the more conservative side. And lastly, the spillover of the LIC IPO from FY22 to FY23 will provide some amount of cushion as far as the current year's fiscal deficit is concerned. So overall, if we weigh the upside risk to expenditure and the upsides as well as the downsides to the revenue side, then they're largely offsetting each other. And therefore, we do at present expect that the fiscal deficit in FY23 for the Government of India is possibly going to print fairly close to the budget estimate of rupees 16.6 trillion. Now I'm going to move on to the next slide on the external account balances. So broadly, at this point, we are looking at India's net oil imports widening by $14 to $15 billion or 0.4% of GDP for every $10 per barrel increase in the average price of the Indian crude oil basket in FY23. So if the ongoing tensions between Ukraine and Russia result in the average price of the Indian crude oil basket in FY23 being $105 per barrel, then the current account deficit is pretty much projected to double to $90 to $95 billion in FY23, which is 2.6% of GDP, from our estimate of $45 billion or 1.4% of GDP in FY22. Regardless, the merchandise trade deficit as well as the current account deficit projections for FY23 will be hugely contingent on the commodity price movements as well as on the duration of the ongoing geopolitical conflict and the supply chain implications of the lockdowns in China. I'm going to pause here and hand over back to Jitin now to take us through ICRA's outlook on various sectors.
Thank you, Aditi, and good evening, everyone. So Prateek, in the initial part of this presentation, spoke about what happened in FY22, and he spoke about that this was a year where he saw a large number of upgrades in ICRA's portfolio. And FY22, in that sense, was an aberration just as FY20 was an aberration, where in FY20 we had seen a large number of downgrades because of the slowing economy, because of the liquidity challenges that the financial sector was facing. So I use the word aberration just in the context that over a long period of time, we have seen that our portfolio hasn't seen so much of an upswing or a downswing, but FY2020 for downgrades and FY22 for upgrades were, in that sense, quote unquote, aberration years. FY22, as Prateek mentioned, was a year where the credit quality did see a significant rebound. So that was what Prateek spoke about. And Aditi, of course, mentioned about the post-pandemic recovery and the uncertainties that the geopolitical tensions have created. Now, in the remainder of this presentation, we are going to be speaking about what ICRA's view is on the outlook on select sectors. Now, on your screen, you're seeing this chart where the categorization between the sectors which are currently on a positive outlook, on a stable outlook, and on a negative outlook are depicted. And then you're also seeing certain highlighted sectors, and these are the sectors which have seen a change in the outlook very recently in Q4 or FY22. And on the next few slides, we're going to be speaking about what drove our outlook changes. But before I do that, let me just clarify one fundamental point relating to what the outlook definition means. Now, these are outlooks which as an organization, we had reviewed our definitions for what an outlook should convey in August of 2021, that is last year. We had defined the outlook on a sector as an outlook on the business fundamentals, which is very different from the outlook on the credit quality of a sector. And one of the key reasons that drove our decision to redefine the way sector outlooks should be used to convey our forward-looking view, we thought that business fundamentals are a more suitable metric. Reason being that in any given sector, you might see hundreds of entities, and those entities need not depict the same direction of credit quality, because the credit outlook also depends on what the parentage of the entity is, what the balance sheet composition of the entity is. But business fundamentals tend to be relatively more homogeneous in a given sector, and hence we chose that one of the key building blocks of credit quality, that is business fundamentals, should be the key marker for a sector outlook. So with this prelude, we can move on to the next slide. And the first slide is going to be talking about what our outlook is for the hospitality sector. And the next few slides are not in any order. Simply speaking, we just chose to talk about these sectors on an alphabetical basis. So here on this slide and on the subsequent ones, you would see that we have mentioned certain indicative thresholds for revisions in outlook. Now, this is just our internal way of deciding as to what should happen in a given sector that pushes us to review and change the outlook in a given sector. So in the hospitality sector, we chose revenue growth and EBITDA margins as the simplistic metrics based on which we take our decisions. And not just internally, we've also in the past very transparently indicated these quantitative thresholds in the public domain so that even the investors and the market participants are aware as to what exactly is the prognosis from ICRA's eyes, what is our projections in a given sector on these markers, and whether those projections are at a level which will trigger a change in the outlook. So talking about the hospitality sector, I don't need to mention about the pains that the sector has seen during the pandemic year. This is a chart on the trend in revenues and operating margins of 12 of the larger hotel companies in India, and these reflect roughly 28,000 rooms worth of inventory. Not a very sizable number if you look at the total room inventory that India would be having, mostly in the unorganized sector. But this is certainly a good proxy of what the specific markets are expected to behave like. So in FY23, which is the ongoing fiscal, we are expecting that the revenues of our sample entities, and which is the proxy for the larger market, at least in our view, that would just be a tad lower than the pre-COVID revenue levels, roughly 3 to 5% lower than the pre-COVID revenue levels. And as far as the operating profit margins of the hospitality sector is concerned, because of the significant cost compression measures that the industry participants had taken, we are expecting that there's going to be a structural improvement in the EBITDA margin profile of the sector participants, and that should reflect starting from FY23 and on to FY24 and 25, because these structural improvements are possibly going to be permanent. But of course, the key downside risk to these estimates is going to be any subsequent chronic waves of the COVID infections that can befall upon us. So we can move to the next slide. So this is media broadcasting, where again we had changed our outlook on the sector very recently from negative to stable. Now, in the media broadcasting sector, roughly 60% of the revenues are attributable to subscription revenues, and 40% of the revenues are attributable to advertisement revenues. Now, despite the advertisement revenues contributing to a smaller share of the total revenue pie, we chose advertisement revenue growth as the key indicator for deciding when to change the outlook. And the reason was that we've seen that subscription revenues have tended to remain more or less stable, or rather less volatile, as compared to advertisement revenues. FY21 was certainly a year where the advertisement revenues for the TV broadcasters, media broadcasters had nosedived. But yes, as that period was behind us, from FY22, middle of FY22 onwards, we saw a superlative jump in the revenue growth. Not only advertisement revenues, but also advertisement yields have been on an upswing, and that triggered an outlook change. The outlook currently is stable. But yes, again, in this sector, one of the watch out items is going to be the new tariff order, the NTO 2.0 as it is called, and the impact that it is going to have on subscription revenues, which is the larger share of the revenue pie for the media broadcasters. We can move to the next slide. So this is on real estate residential. And again, this is one of the sectors which had seen a lot of lows in the pandemic. But even prior to that, when the system level inventory had grown quite substantially. But yes, as time has progressed, what you've seen is that the years to sell in the top 8 cities at least, that number is currently at a multi-year low. It currently stands at 2 years. So this has been our threshold for deciding the change in outlook. Over and above that, what we've also seen that at least in the top 7-8 cities, the new project launches have also seen a rise. In FY23, we're expecting roughly 410 odd million square feet of area to be sold in relation to 400 million square feet of area that was sold in FY22. So again, we are expecting that the system level inventory is going to be quite low now. As we look ahead, new launches have seen a rise. Sales momentum has been seen for various factors, as I mentioned in the first bullet point here, and that has been the trigger for changing the outlook to stable for the residential real estate segment. 2 more points on this slide. Firstly, that we have seen that in this sector, there's certainly a basket case for K-shaped recovery. We have seen the larger branded players have seen a very strong sales momentum, which has not been the case as much for the relatively smaller players. So certainly this is one sector where the disparities between the stronger players and the weaker players have been relatively more stark. And the second point, of course, is that for these stronger players, pricing power has also returned. And this pricing power is not just an outcome of the commodity inflation that has been there, which the entities are passing on. But even otherwise, we've seen that these stronger branded players have seen an increase in the value of the properties that they're selling. So just to give numbers, vis-a-vis 6,600 rupees per square feet, which was the average sale in FY22, we are expecting that in the next year, which is FY23, roughly 7,500 rupees per square feet would be the value at which, at least in the top 8 cities, there would be sales that will get affected. So moving on to the next sector. Again, another segment of the real estate segment, which is the retail malls, that is. Here, rental income growth had suffered in FY21, as this chart shows that we'd seen a 50% decline in the revenues in the rental income. And this is corresponding to 22 malls that we had analyzed reflecting roughly 13 million square feet of area, which is roughly 10% of the pan-India space that is there across 7 cities and 7 states and 11 cities. So in FY23, as we go into FY23, we're expecting that the waivers and discounts, which had become quite a necessity for the tenants to seek from the retail mall owners, that is perhaps going to no longer be the case in FY23. This is validated by our interactions with various mall owners, various tenants, and that also triggered the change in the outlook on this sector from negative to stable. Moving to the next sector. Telecom services. This has been one sector where a lot of upheaval has happened in the past. You will see a simple metric called ARPU, average revenue per user, which is mentioned on this slide. Of course, this is a very simplistic way of representing this sector. This is not the only metric, one can argue. ICRA is also going to be publishing a very detailed report on the outlook on a large number of sectors between today and tomorrow. We are going to be publishing that report. And in that report, you can find more details on not just the telecom services sector, but various other sectors also. But about the telecom services sector, there have been favorable developments in terms of the AGR dues and the spectrum liabilities, all these sector participants getting a moratorium of 4 years from the government of India, which has eased the balance sheet pressures and liquidity pressures. So overall, the credit profile has improved substantially. But yes, as far as the business fundamentals is concerned, ARPU is certainly a very simple metric which drives return on capital employed for the sector participants. So from a nadir of 109 rupees in FY19, we've seen that there has been a consistent rise in the ARPUs, and this is driven by both by the price hikes that the industry participants have taken after the initial bout of predatory pricing. In December 2019, there was a first price hike, and very recently in December 2021 also, there has been a substantial price hike of almost 20% in the prepaid tariff plans affected by various telecom operators. Of course, the benefit of these price hikes are expected to reflect in the P&L of the sector participants from Q2 or Q3 of FY23. Reason being that the existing tariff plans do have a lock-in, and those tariff plan lock-ins are going to expire in the middle of next year, an ongoing year, that is. So tariff hikes, there has been an increase in the usage also, plus there has been a good shift from the 2G to the 4G subscriber base. That has also resulted in an organic growth in the ARPUs. Of course, interconnect usage charges have been abolished, and that has resulted in the ARPU levels being moderated. But otherwise, by and large, we are expecting that the industries is not going to be facing as much business pressures as it had faced in the past, and hence that triggered us to change the outlook on the sector from negative to stable. Moving on to the next sector now. So we've talked about various corporate sectors. This summary slide is about the financial sector. Yes, you see a lot of numbers here, and the slide might look a bit cluttered. But just to give you the key message of this slide, the key message is that various segments of the financial sector, small finance banks, HFCs, MFIs, NBFC, retail, many of these segments had been facing much more chronic credit asset quality pressures as compared to, for instance, banks or NBFCs in the infrastructure financing space. But recently, we have changed our outlook on these other sectors. Within the financial sector also, the outlook has been changed from negative to stable. We are expecting asset quality pressures to be much more moderated in FY23. We are expecting credit growth to return. As credit growth returns, operating efficiencies are going to increase. Operating costs are going to be relatively lower in relation to the total asset base, which will have a favorable impact on the profitability. And of course, the balance sheet also will get eased out. But yes, on the balance sheet, in any case, most of the financial sector segments, we are seeing that the capitalization levels reflected in the CRAR, the capital adequacy numbers, these are relatively more healthy now. And hence, even on the credit quality side, the financial sector looks in a much better shape compared with what the situation was 2 to 3 years ago. Moving to the next slide. Oil and gas upstream sector, it's facing these commodity tailwinds. Crude is where we know where it is. Gas prices are also expected to be much higher in FY23. We have these quantitative thresholds, as you see on your on this slide. So we expect that the Brent crude oil price is going to be much higher than $75 per barrel, which was the lower threshold for deciding a positive outlook. And because we're expecting that these levels are going to remain somewhere between 85 to 100 USD per barrel, that triggered a change in the outlook from stable to positive. We can move to the next slide. Just a couple of more sectors. So on roads, here, because of the fact that WPI has increased very significantly, that is going to have a favorable impact on the revenue growth of toll road operators. This is, of course, the unlisted space mostly. And here, toll collection growth is what we're expecting to be much higher in FY23. As this chart shows that it could be anywhere between 70 to 20% as per our estimates. And WPI is going to be a big contributor to this. Apart from that, there would be likely an organic growth in traffic. Traffic growth is not that is going to be driving the revenue growth. As you would notice on this slide, that we're expecting traffic volumes to grow by a modest 5 to 6%. But as I said earlier, the WPI effect is going to result in it's going to be the biggest kicker for the total toll collection growth. And then finally, to the next slide on textiles. This is a sector where the exports prospects really swing the way in which the industry participants achieve revenue growth and profit growth. That said, if you look at the domestic spinning sector, roughly 70% of the demand comes from the domestic market. Roughly around 30% of the demand comes from the export markets. And just like we had discussed in one of the previous slides about the advertisement sector, even in this sector, the smaller component, the smaller contributor to the revenue pie, which is exports in this case, that was chosen by us as the marker for the threshold for deciding the changes in outlook. And the key reason for that is that we've seen that export volume growth, export revenue growth, and the spot contribution margins driven by that, they become the key driver for the sector's business fundamental prospects, because domestic demand tends to be by and large stable or rather less volatile. And in the domestic textile sector, FY22 was a year which was a blockbuster year. The industry participants reported multi-year high gross contribution margins, revenue growth, and there are many factors for that. One of the key factors was that in the case of China, we saw that the Xinjiang cotton variety there that faced concerns from the US and the European markets. The buyers there were not buying from China as much because of human rights concerns, and hence the demand for apparel shifted to Bangladesh. And India's exports of cotton yarn then were channeled to Bangladesh, and that became a key driver of the revenue growth that the industry participants reported. Apart from this factor, we've also seen that the downstream segments like apparel exports, home textiles, they've also seen a good jump in exports, and that has had a favorable impact on cotton yarn demand in the domestic market. And finally, in the middle of the last year, sometime in August 2021, if I'm not mistaken, there were certain changes made in the tax and duty exemptions that the industry participants were eligible to take. The earlier scheme, the MEIS scheme, was replaced with the remission of duties and taxes scheme, which again became applicable for certain specific varieties of cotton yarn that India was exporting. That benefit was not there the earlier years, and hence FY22 became a year in which multiple factors became these drivers for the industry participants to report exceptional revenue growth and EBITDA growth. And we are expecting that these trends are going to remain applicable even in FY23, and hence the reason for changing the outlook on this sector from stable to positive. So with this, we've covered the various sectors that we wanted to speak about, specifically on the outlook changes that have got affected in the recent periods. But yes, just to remind that not just this presentation, but few other presentations, a few other reports also on sectoral outlooks are going to be available on ICRA's website. And if you are interested in more details, please feel free to have a look at those reports. And with this, we are at the end of the presentation, and the floor is now open for the questions and answers.
Thank you, Jitin. So just as a reminder, in the Q&A, we are joined by Mr. Ravichandran and by Mr. Karthik Srinivasan. So you can pose any questions to them as well in the chat box at the bottom. While we're waiting for the question queue to assemble, I have a couple of questions that I want to kick off with Ravi and with Karthik. So for Ravi, the question for you is, has there been any material impact on the credit profile of ICRA-rated companies on account of the ongoing Russia-Ukraine conflict? What are the sectors that we should be concerned about if the conflict prolongs? Over to you, Ravi.
Yeah, thanks, Aditi. Of course, we reviewed our rated portfolio on account of this, emerging risk. While on the face of it appears that India would have a huge, impact, through various macroeconomic and other, factors. But when it comes to the portfolio level, we realized that largely, it is credit neutral. Just because of the fact that if you look at the affected sectors, the biggest sector would be oil and gas, and within that, refining and marketing, and wherein companies are, largely sovereign owned, and to that extent, their ratings are not, likely to be under pressure. While their marketing margins have been under pressure of late, but we believe that for a period of time they'll be able to recoup their margins, and to that extent, they would be able to retain their credit profile. And other major sector wherein there will be some impact would be fertilizer sector, wherein the market participants would be aware there has been a very sharp rise in the prices of global fertilizers, and so to the extent there is pressure on the input cost for these companies. So most likely government will have to come out with additional subsidy, otherwise margins of the industry could be under pressure. So the subsidy rates are yet to be announced for the year, but hopefully that will be done. Otherwise, there can be huge increase in the retail price of fertilizers. So with that assumption, we believe that even the sector's profile will be somewhat stable. Other sector would be the export-facing sectors like pharmaceuticals, wherein we don't have too many companies with the high exposure to Russian market. We just had one company with very high exposure, and wherein we had only marginal investment grade rating BBB-. In light of this uncertainty, we have downgraded the entity. Otherwise, coffee exporters and other engineering goods exporters, of course, we do have in our portfolio. But then in the overall scheme of things, they don't amount to much, and because of which we believe that it wouldn't have much impact on our rated portfolio. But importantly, what we have to see is what lies ahead for the participants. Key thing would be to see how long this war prolongs. In case the war sustains for a longer period, the high oil price impact can be quite serious, and it will have a cascading impact on the downstream industries. Already margins are under pressure, for many of the downstream sectors. So that is one key thing that we have to watch out for. And other would be, to what extent some of these companies are able to pass on that to the consumers. Some sectors, especially FMCG and pharmaceuticals, etc., they have certain pricing power to the extent they're in a position to pass on that to the consumers. Other sectors wherein there is a high level of fragmentation, it's going to be difficult to pass on. So it all depends upon how long this war sustains and how quickly the industry is able to pass on. So that's what we'll be keenly watching out before taking further rating actions.
Thanks, Ravi. And a question for Karthik now. Is the asset quality pain over for the BFSI sector?
To a large extent, yes. We need to look at it in two ways. One, we've had issues with legacy assets, especially the banks, the wholesale infra assets and large corporate assets. Most of the lenders have adequately provided for the same. So incrementally, we don't expect any sizable provision on account of the legacy assets. And in terms of the recent crisis related to the last 1.5, 2 years on COVID, most of the lenders have had sizable provisioning done on these assets, or incremental or additional provisions done on account of COVID overlays. with the revival in economy and we're seeing risk appetite come back slowly, we do believe that possibly the worst is behind us in terms of asset quality, though there could definitely be few players whose numbers continue to remain stretched for a longer time. Optically, with the RBI circular of daily classification of NPA, the November 21 circular, could sort of result in headline numbers going up in the current year. But with growth on the overall advances portfolio, some recoveries from the delinquent assets, we do expect the numbers to be tapering down going forward. So in that sense, we do believe that notwithstanding any new shocks, which not anybody has seen, but other than that, the numbers should trend downwards as far as asset quality is concerned.
Thanks, Karthik. We have a question now, which is, what is the proposed outlook on renewable energy owing to the high cost of fossil inputs in the energy sector? Jitin and Ravi, if you would like to take.
Yeah, I mean, of late, there has been a lot of activity around the renewable energy, both on the wind side and solar side. India itself has a huge vision of developing renewable energy assets over the next 10 years or so. Now, if the oil prices were to remain at the current level, it will only accelerate that process, and we are going to see renewed demand for solar and wind. So it's going to be hugely positive for the sector participants, and I'm sure there will be more participations from the industry level whenever there is whenever there are auctions for the renewable energy projects, both at the central level and state level.
Okay. So my next question is for Jitin. There has been a sharp rise in energy, metals, agri-commodity prices recently, which has put pressure on the margins of end consumers. What are the sectors which could see weakening in the credit quality on account of this?
I think there are a large number of sectors which depend on these inputs as their feedstock, and that has an impact on profitability. If I speak of any of the chemical sectors, agrochemical sectors, fertilizer sector, as Ravi spoke about, which energy costs are on the rise. So if you look at the aluminium sector, steel sector, where energy costs are the key inputs, key cost contributors, all these are going to be affecting the profitability. Specifically speaking about ferrous metal sector, you've seen how coking coal costs have just gone through the roof. Iron ore prices internationally have been on the rise. And even though the realizations for the ferrous metals players has been high and is expected to remain high in FY23, but because of these cost pressures, the profits would not be as high in FY23 as they were in FY22. Paint sectors, with many paint companies use oil derivatives. There again, these margin pressures are going to be there. So inflationary effect is going to perhaps not leave anybody untouched, any sector untouched, unless you are in a sector where you are not just a sector, but a participant in that sector, which has a very strong bargaining power, ability to pass on the increased costs to customers. There would be perhaps a handful of entities across various sectors, but by and large, I think most sectors will face the inflationary pressures and consumption demand could get hit. And that's precisely one of the reasons why ICRA recently revised its GDP growth outlook from 7.8% to 7.2% recently, because a large mix of our GDP pie comes from private consumption.
Thanks, Jitin. The next question, what is the outlook on the Capex cycle? Ravi, maybe you can go first and I can add some macro comments to your answer.
Yeah, when it comes to Capex, from government point of view, they have been providing adequate funds for the infrastructure Capex, both on roads and metro rail and airports and so on and so forth. So that is quite positive for the industry. So that is one segment wherein it's mostly stable and it has been only improving over the years in terms of outlay. When it comes to private sector Capex, of late, these PLI announcements have been, a major driver, and we believe that Capex will accelerate over the next 4 to 5 years. More than 3 to 4 lakh crore worth of Capex we are expecting across 14 sectors wherein these PLI schemes, are there. In addition to that, metal sector could also be seeing, Capex, in the sense that existing steel companies, they have announced brownfield expansions, and few of them have also announced, greenfield projects. In addition to that, oil and gas has always been steady with its Capex, and within that, city gas distribution is one subsegment wherein one can expect renewed Capex because of the new licenses which have been awarded, to cover the length and breadth of the country. In addition to that, sugar is another small sector wherein we are seeing a lot of Capex, especially around these ethanol projects, because of the attractive, ethanol pricing. IRR of these projects are fairly good, and almost all leading sugar companies have announced Capex. And while it wouldn't amount to much in the overall scheme of things, but that is one sector wherein fair amount of orders are there, for various vendors like large industries and so on and so forth. So broadly, these are the sectors wherein we are going to see Capex. One other sector where I forgot to mention is renewable energy. As I mentioned earlier, power within the power, where thermal projects have come to a standstill. On the renewable side, investments have been fairly robust, and with the current oil and gas pricing regime, we believe that Capex will continue to be increasing going forward.
Thanks, Ravi. So I just add a couple of things, in terms of the RBI's data on capacity utilization. What we have right now is quite dated. We have the data for Q2 of FY22, and that indicated a capacity utilization of 68%. Our estimate at ICRA is that capacity utilization is likely to have risen to about 71 to 72% in the Q4 of FY22, which is the quarter that just ended. Thereafter, we expect the improvement to actually be very modest. First of all, as Ravi mentioned, capacity expansion is happening in certain sectors, and as capacity comes online, then that is something that increases the denominator. But more importantly, when we go ahead, there's one positive and there is one negative. The positive is that on the export side, we do expect, as all of us have been saying, some sectors to benefit from the supply chain disruptions, and that should improve the capacity utilization. But on the consumer side, as I had indicated earlier, and so have many of the other speakers, there is a concern that the commodity price inflation is going to eat into demand. And for the higher income categories, we do expect that there will be a pivot more towards the consumption of services. And both of these are going to really slow down the pace of capacity utilization increase. We now expect it to be around 74 to 75% by the end of this calendar year. And 75% is really the threshold that we historically believe needs to be crossed before there is very widespread capacity expansion being announced by the private sector. So for the interim, we expect that the targeted sectoral Capex that Ravi just talked about, that will be the dominant theme, and broad-based Capex will come in possibly only in the next calendar year. Our next question is, any sense on Capex on green hydrogen?
Yeah, on green hydrogen, of course, all large oil and gas companies, they have announced projects around this. Whether it is from Reliance Industries or recently you would have read Indian Oil has tied up with L&T and Renew Power, to set up a green hydrogen project. Of course, on paper it would appear very attractive, but key thing would be to realize the price of hydrogen at certain affordable level. It has to reach less than $1 per kg. So today, it's about $3 to $4 per kg. Unless it reaches that kind of a level, it's going to be challenging, to make it economically viable. So, well, technically, it is possible to produce green hydrogen from the available technology. Key thing would be to lower the cost of production through both Capex as well as Opex optimization. Only then, green hydrogen will be viable. Otherwise, hydrogen as a revenue source, as an energy resource, may not find too many takers.
Thanks, Ravi. I'm going to pose the next question to Prateek and Jitin. The upgrade-downgrade ratios that you mentioned for FY21 and 22, if we average those, we seem to be closer to the longer-term trend. Even though the performance in these specific years is very aberrant, would you expect FY23 to revert closer to the longer-term averages?
Yeah, like as Jitin also highlighted, see, rather if you look back, FY20 was an average in terms of downgrade and FY22 was an average in terms of upgrade. So if we, rather than 2 years, if you look at an average of these 3 years, so it's already towards the long-term average which we observed in the past in terms of upgrade and downgrade rate. Moreover, what we observed is the commodity cycle is largely played out in FY22 and the rating actions going forward are likely to be driven by company-specific factors. Moreover, given the evolving global macroeconomic conditions, so we feel that in terms of headline numbers, the numbers should gradually converge towards the long-term average going forward.
Thanks, Prateek. So the next question is, any major event on your radar that can severely impact the Indian economy as a whole? I think after last couple of years, black swans, I mean, another unexpected wave of the pandemic, a strain of COVID-19 that beats all the current vaccines, that would certainly be, it for me. But any of you, if you would like to offer any other such black swan event.
I mean, that would be certainly oil prices. Today we are talking about $110, $120 kind of a pricing. We all believe that this war will be short-lived. But in case it turns nasty and turns nuclear or it turns even more vigorous, then prices can spiral to $160. That can be hugely damaging for the Indian economy, given the high reliance on imports. It could have both, impact on our exchange rate, inflation, and the margins of all the downstream players. So that could be quite catastrophic. But of course, I believe probability of that event happening is relatively low. One has to wait for that and see.
Thanks, Ravi. My next question is for Karthik. Will access to funding avenues improve for the NBFCs?
We expect funding access to improve for a couple of reasons. Last couple of years, the principal lenders to NBFCs, which is banks, they've had a very slow growth. Their capital profile and position is much better today as compared to a couple of years back. As they have to a large extent cleaned up their balance sheet and sort of ready to embark on the growth path with the revival in the economy. Today the NBFC accounts for almost 8.5% of the overall banking sector exposure, while the RBI cap could be 15, but basis our discussion, most of the players do have their own internal caps around that 8-9% kind of levels. So the expectation is that the banking sector growth would also pick up. It may still remain not great, but we do expect the banking sector growth in that vicinity of 9-10% for the current financial year. That does provide a little bit more flexibility to banks to increase the exposure towards NBFCs as well, depending on their risk appetite. The other thing which one has also been hearing about for quite some time is will co-lending be a big thing going forward? Last 2 years, while we've seen a lot of entities engage in tie-ups with banks and other co-lending partners, but the pandemic and the risk aversion sort of did not help grow the book. Today, we see that a lot of integration between the two parties are already done and people are ready. So to that extent, co-lending also can become a viable and a good option for funds for NBFCs. Putting the two together, the access to funds for NBFCs should definitely be better as compared to the last couple of years. The only thing of importance would be, again, funds would only possibly be available to entities who are in a position to show up a fairly decent asset quality number. So to that extent, that will always be one of the key tick boxes for entities before you start to expect funds from the bank. As far as bond markets and debt capital markets are concerned, notwithstanding the fact that the AUMs of mutual funds and insurance have grown pretty smartly over the last couple of years, but there, given the MTM concerns, the expectations of rise in interest rates, the funding might still either be available only to stronger entities or maybe on the shorter duration scale. But in general, we do expect the avenues of funding to improve for NBFCs in general.
Thank you, Karthik. A final reminder to our participants to put any other questions in the chat box. So I think we don't have any more questions in the chat box. So I'm going to thank all of our participants for joining us today, and thank you to all our panelists for sharing your insightful views. Good day, everybody.
Before we close, Aditya, I think there are a few questions just came on the chat box. We can take those.
Okay. Thank you. What's the take on coal shortage and peak power production?
Yeah, certainly, we have been facing, coal shortage, and that is impacting both power producers as well as, people who are using, coal as a source of energy input. Certainly it is having a margin impact on the on the industry, and spot energy prices have been going up over the last month or so. And as per our internal analysis, because of the low inventory, it's going to take quite a bit of augmentation of production by Coal India Limited for us to reach normal level. So at least for the next 1 year, it's going to be very tight, for the Indian market. Premium in the e-auction of Coal India would remain elevated, and to the extent both the spot energy prices as well as the cost of power would remain at elevated level. So for things to improve, Coal India is the primary player which has to augment its production. Otherwise, on the global scene, since Russia is one of the important player in the traded coal market, and Russian coal supplies have dwindled of late because of the sanctions and other related matters. So unless the war ends quickly and sanctions are also withdrawn, global pricing would also be very unattractive. So import is not an option. We have to rely primarily on the domestic coal, wherein again outlook is not that sanguine because of the demand outstripping supply. So on the coal front, things are really negative, from our consumers' point of view. Jitin, would you like to add on to that?
Yeah, just a couple of points, if I can add. Firstly, yes, as Ravi explained, that the burden of increasing supplies lies on Coal India. But also what we have seen from the data available publicly is that the lack of availability of rakes, that also has been a key contributor to the shortages and the lower stock levels that the various thermal power plants in India currently face. And what the situation did was that the supply got rationed out, and the priority was toward the thermal sector rather than sectors like aluminum or steel, which are other key users of coal, coking coal. So even if in FY23, Coal India is able to increase the production in double digits, that again is going to be a Herculean task, because in the past several years, Coal India has never achieved a double-digit growth. But yes, one need not get too much influenced by what has happened in the past. Things can change for the better. But yes, these are some of the risks that are currently being faced by India Inc. And in some ways, the history also is against us in terms of the traction in production that is going to be required to meet the demand currently.
Thanks, Jitin. And we have a follow-up question for Karthik. For what products do you expect co-lending to scale up first? And the next question is, which segments of credit, such as mortgages, SME, CV, etc., are exhibiting very few slippages relative to their normal levels?
From a co-lending point of view, it again depends on which is the NBFC which is tying up. What we understand is currently the focus is more on the SME LAP varieties. That's a segment where we've seen or noticed a lot of interest between parties. The other segment where one is also seeing co-lending is on the small ticket unsecured kind of loans, but maybe the AUM growth would be lower out there, given not only are the ticket sizes smaller, but also the tenor. If one wants to just look at the AUM, let's say 6 months, 12 months down the line and answer your question, then in all likelihood, it could be the SME stroke lab kind of a segment, which would see some pickup as far as co-lending is concerned. In terms of segments which are exhibiting low slippages, currently, I think last couple of quarters, all segments have shown a rise in delinquencies. The points to be noted is, mortgage is still, the delinquencies are much lower as compared to the other segments. So the overall trend is likely to be maintained. It is going to take some time. For most of the levels, asset classes, the delinquency numbers are almost double what they were pre-COVID days. It takes some time before the numbers come down. But clearly, from a directional point of view, with an improvement in the macro and also tightening of the credit filters for new originations, clearly we are seeing incremental slippages come down. The only thing to be noted, and one doesn't have a full data at this point of time, is reported numbers may not completely show this because static pool-wise data is not really made available for all players, for all asset classes. So thanks to COVID 1 and 2, the restructuring, a lot of these restructured assets will come out of moratorium in the current financial year. So depending on how much moratorium the lenders had provided to these assets while restructuring and how they play out could possibly have some bearing on reported delinquencies and NPAs going forward. But net, we do expect gold and mortgage home loans to be, and car loans, basically these three to have lower delinquencies as compared to the other retail asset classes.
Thank you, Karthik, and thank you to our audience for sending in those questions. I don't see any more questions now in the chat box, so I'm going to say thank you and good day to all of you again, and see you soon at another one of ICRA's webinars.